Welcome to Upstride, where smart people learn real strategies, think sharper, and spot opportunities others miss. Most people hear Iran war and think only about missiles, headlines, and panic. But the money story is different. The real issue is not just conflict. It is what conflict does to oil, shipping, inflation, business costs, hiring, and investor behavior. And right now, those effects are already showing up in markets and supply chains. As of March 31st, oil was still trading above $100 a barrel, with Brent around $107 and U.S. crude near $103 after a huge jump since the war began on February 28th. The Strait of Hormuz remains the center of the risk because around 1/5 of global oil consumption and about 1/5 of global LNG trade normally move through that route. When that choke point gets disrupted, the shock does not stay in the Gulf. It spreads into transport, manufacturing, food, e-commerce, inflation, and household budgets almost everywhere. And this is exactly why hidden opportunities appear in crisis. Most people freeze. Smart operators simplify the situation. They ask 5 questions. What is getting more expensive? What is getting delayed? What is becoming more necessary? What are people scared of? And where will money flow next? If you answer those 5 questions early, you stop behaving like the crowd and start positioning like a decision maker.
First, let's make the crisis clear. The IMF said this war is already dimming the outlook for many economies, especially countries that were already vulnerable. The IEA has described the current supply disruption as the largest in the history of the global oil market, driven by attacks on infrastructure and the near halt in shipping through Hormuz. That matters because higher energy costs usually mean higher inflation and weaker growth at the same time, which is one of the ugliest combinations for households and businesses.
The second layer is shipping. This is where many people miss the opportunity. When conflict disrupts the Gulf and Red Sea routes, ships reroute, delivery times stretch, fuel costs rise, insurance gets more expensive, and carriers pass those costs on. Reuters reported that rerouting around Africa can add 10 to 14 days, and some carriers are already charging surcharges of $1,500 to $4,000 per container. Hapag-Lloyd said the war is adding $40 million to $50 million in costs every week. That is not just a logistics story. That is a pricing story, an inventory story, and a cash flow story.
The third layer is spillover into real businesses. UK retailers are already warning that the war is adding to shop price inflation. Kenya is dealing with fuel shortages. Europe is trying to coordinate energy responses because gas and refined product markets are tightening. Even industrial materials like aluminum are getting hit by supply fears. So if you run a business, this is not abstract geopolitics. This becomes higher procurement costs, slower restocking, weaker consumer confidence, and tighter margins.
Now here's the shift most people miss. In every crisis, some sectors get punished, but some become more necessary. And necessity is where opportunity lives. The first hidden opportunity is in boring businesses that reduce cost, waste, or uncertainty. When oil rises and shipping slows, companies suddenly care more about route planning, fuel efficiency, inventory control, sourcing flexibility, demand forecasting, and cash conversion cycles. In normal times, many firms delay those upgrades. In stressed times, they pay attention fast. So if you work in operations, procurement, analytics, ERP, warehouse systems, forecasting tools, or cost control, your skill is more valuable in this environment because it directly solves a pain point. The second hidden opportunity is cybersecurity. When geopolitical conflict rises, the digital risk environment usually gets worse, not better. Governments, utilities, logistics systems, ports, manufacturers, and financial institutions all become more alert to cyber disruption. That does not mean every company suddenly doubles its security budget overnight, but it does mean security moves higher on the list of must-fix items. That creates opportunity for people learning practical cybersecurity skills, especially in monitoring, access control, cloud security, incident response, compliance support, and security awareness operations. The title of the opportunity is not war. The title is Risk Just Became More Expensive. And when risk becomes expensive, protection becomes easier to sell. The third hidden opportunity is in energy-adjacent businesses. When the market gets hit by supply disruption, the immediate winners are not always oil traders. Often, the more durable winners are businesses helping users consume less, plan better, or switch smarter. That includes industrial energy efficiency, building management, backup power, grid software, maintenance, inspection, energy data tools, and cost optimization. In plain English, when energy gets expensive, people suddenly want systems that reduce waste. That demand does not depend on hype. It depends on economics. The fourth hidden opportunity is supply chain diversification. Reuters has reported that a riskier Middle East is already pushing large energy companies to think more seriously about alternative regions like West Africa, Brazil, Southeast Asia, and others. That mindset does not stay inside oil. It spreads to sourcing, manufacturing, logistics, and trade finance. Businesses begin asking whether they are too dependent on one route, one country, one warehouse, one vendor, or one payment flow. Anyone who can help a company diversify suppliers, build backup processes, or redesign sourcing strategy becomes more valuable in this kind of environment. The fifth hidden opportunity is for e-commerce sellers who think 2 steps ahead instead of 1. Most sellers respond late. They wait until ad costs rise, margins shrink, delivery complaints increase, and customers start hesitating. The smarter move is earlier. Shorten inventory risk. Prioritize faster-turning products. Avoid bulky, low-margin items that get crushed by freight and return costs. Reduce dependence on fragile imports where possible. Keep more cash than usual. And tighten your offer. In unstable periods, consumers become more selective. They buy problems solved, not random products. So crisis punishes lazy stores, but it can strengthen focused stores. That brings us to prevention, because opportunity without protection is just another form of gambling. Step 1 is cash discipline. In a crisis environment, cash is not laziness. Cash is optionality. If oil stays high, inflation remains sticky, or transport costs jump again, the people with some liquidity can absorb shocks and make better decisions. The people with no liquidity get forced into bad ones. That means households should reduce unnecessary fixed commitments, and businesses should watch burn rate, working capital, and restock timing more closely than usual. Step 2 is protect your budget from second-round effects. The first shock is oil. The second shock is everything oil touches. Delivery, groceries, utilities, travel, packaging, imported goods, and even shop prices start adjusting with a lag. That is why the IMF is warning about renewed inflation pressure and slower growth if elevated energy and food prices persist. Waiting for your monthly expenses to suddenly get worse is a weak strategy. Review recurring costs early. Lock in what you can. Cut what is low value. The earlier you adjust, the less painful it feels.
Step 3 is do not confuse panic assets with good decisions. In unstable periods, people run emotionally toward whatever they think is safe. We have already seen stronger interest in gold and other defensive assets, while equities in some markets have come under pressure. But the smart response is not to copy the crowd blindly. The smart response is to understand your purpose. Cash protects flexibility. Gold may help some investors hedge fear and inflation risk. Productive assets still matter if your time horizon is long enough. The mistake is emotional all-or-nothing behavior.
Step 4 is upgrade skills tied to uncertainty, not comfort. This is where many viewers can actually act today. If the world is moving into a period of higher geopolitical risk, supply shocks, tighter margins, and more fragile systems, then skills connected to resilience rise in value. Cybersecurity, cloud operations, data analysis, procurement, financial planning, automation, logistics coordination, cost control, risk management. These are not trendy because they sound exciting. They are valuable because companies need them more when conditions get harder. Step 5 is think in terms of problems, not headlines. The headline is Iran. The business problem is cost volatility. The consumer problem is higher prices. The company problem is margin pressure. The infrastructure problem is root risk. The digital problem is rising attack exposure. The hiring problem is needing people who can operate under stress. Once you translate headlines into actual problems, you stop being overwhelmed. And once you identify the real problem, the opportunity becomes visible. So what are the practical actions right now? If you are a household, build a short emergency buffer. Review transport and energy-heavy expenses. Reduce weak subscriptions and impulse spending, and avoid taking on fragile debt just because rates or monthly payments look manageable today. The wrong debt becomes much more painful when inflation and uncertainty stay longer than expected. If you are an investor, focus less on prediction and more on resilience. Understand your time horizon. Know your liquidity needs. Avoid forced risk behavior. If you do nothing else, at least know why you own what you own. In unstable conditions, confusion is expensive. If you run an e-commerce or small business, review suppliers, shipping exposure, stock coverage, and product mix this week, not next month. Ask which products break first when freight rises or delivery slows. Ask where your margin disappears. Ask what customers still buy when they become more careful. That is where your business needs to tighten. If you are building a career, stop chasing broad motivational noise and choose one capability linked to risk reduction or efficiency improvement. That could be cybersecurity basics, cloud support, data dashboards, financial modeling, automation for small business, inventory systems, procurement analytics. In a weaker environment, the market rewards people who make operations safer, faster, cheaper, or clearer. And here's the final point most people miss. Crisis does not create opportunity for everyone equally. It rewards people who prepare before the pain becomes obvious. By the time the average person feels the full effect, the best moves are already crowded. The goal is not to become paranoid. The goal is to become early. So yes, this war is a crisis. Oil is higher, shipping is disrupted, inflation risk is back, business costs are under pressure, and the global economy is more fragile than it looked a few months ago. But hidden inside that stress are very real opportunities. Resilience skills, cost-saving businesses, cybersecurity demand, supply chain redesign, energy efficiency solutions, and smarter cash management.
The people who benefit will not be the loudest. They will be the ones who understand what is changing and act before everyone else does.
Subscribe to Upstride if you want real strategies, sharper thinking, and opportunities most people miss.